The Money Show.
Personal Finance with Warren Ingram.
So Warren Tabiso, Warren is director at Galileo Capital. He's a regular contributor to The Money Show. And tonight we're looking at what Tabiso's problem, because I'd like to try and solve Tabiso's problem. I think many of us have a similar problem. I'd like to replace my 10-year-old car with a decent low-mileage demo model. I've saved up some funds for the purchase, but I'll need to take out vehicle finance for about 40% of the value. I plan to pay it off over 2, maximum 3 years, but I'm not sure if I should go ahead with a fixed interest rate or a linked interest rate. What do you think is the best way to go, since interest rates are so high at the moment? Regards, Tabiso. Let's talk, I suppose, more broadly, if we can, Warren, just about some principles with which Tabiso is grappling, and then we'll get into the specifics of his question.
Yeah, I think it's an issue that faces almost all of us in South Africa when we start to earn, a decent salary. Going from relying on public transport to being able to drive ourselves becomes not really a luxury, but almost a necessity to make sure we can generate an income and make a living and do it as safely as possible. And when public transport is as unreliable as it is in SA, then this is a necessity. So cars are in South Africa, I think, as opposed to some other countries, cars are a necessity for a lot of people. The other part of that point, though, is we're dealing with, let's say, a marketing machine that I think stands back for nothing. The motor dealerships are, I think, the best marketers in the world. And the way that they sell their product to us, there is absolutely no doubt in our minds that when they issue a new model, that model is goes from being something that's nice to have to an absolute necessity. That's how good their marketing is. I'm a self-confessed car addict, so I'm one of those, and I have to fight the urge to buy the new car, so I make sure I never buy a new car is the answer. But we get sold these things as a necessity, and they come out every 2 or 3 years with an upgrade or a new model, and the car is so emotive in the way it's positioned with us that it's very hard to make a sensible, rational decision for most of us. So we're dealing with two things: one, a necessity, and then two, almost kind of, it's irresistible marketing machine. Added to that is then...
So how then do we do it? Do we set ourselves a budget? Say, look, I can afford 300,000 or 500,000 or 750,000, whatever the number is, and simply stick to that number. And if the car we desire is above that number, we don't do it. We don't buy it, because we've all got our limitations. We need to know what our limitations are before we even start looking at cars.
Well, I think you're hitting the third pillar of this whole this whole conversation on its head, which is the last part of the machine is the financing machine. And so between the dealerships and the banks, they will pitch affordability in a different way to the way you've described. So the way you're talking about it, I think, is exactly right. We should, if we do this rationally, we should say we're going to spend 200,000 or 100,000 or whatever your number is on a car. And if I don't have I can't find a car in that bracket, it means I can't afford a car. Unfortunately, the finance machine does it differently. What the finance machine does is says, how much can you afford on a monthly basis? And if you can afford 7,223 Rand, then how about we structure your finance deal to make that work? And that could look like zero deposit up front, 7,200 every month for the next 6 or 7 years. And then at the end, don't worry about it. But, there's this thing called a balloon payment. And so we go.
And everybody's doing it. Everyone's doing it because... cars are expensive, but we make it affordable for you because, look, in 5 years' time, you're going to be far more advanced in your career. You'll be able to afford that balloon payment. You'll be able to do it because you're so good at your job, and you're a massively aspirational individual, and of course you're going to advance in your career. So yeah, let's look at what your affordability is, not what you can afford, but what your affordability is, and those are two different things.
Absolutely, and added to that will be some of these finance houses will also look at some sort of a guaranteed future value. So if you only drive the car for 34 kilometers a month for the next 5 years, we'll guarantee that we'll buy the car back from you at 50% of the value you're paying today. And so that's the other little hook that gets into this whole thing. So there is a lot for a car buyer to deal with, and I think. We need to do this in steps, and I think the very first step is exactly the approach you've just suggested, Bruce. Start with, I can afford a lump sum of X, whatever your number is, and before you go and shop for a car, before you go and look at what cars, the new, whatever the new model is that I really want, how much does that cost? Because then somehow you'll find a way to make that affordable. You need to start by saying, this is my cash budget. This is what I can afford. And if you don't, and most South Africans simply cannot start by buying a car cash. It's just not practical or possible for them. If that's the case, then you say, okay, I can afford, whatever it is, 3,000 Rand a month as a monthly debit order to pay for a car and pay it off over 3 or 4 years. And that means I need to save X as a deposit, and I need to be sure that I've got insurance and all the other things that I need to fund that car in addition to the monthly payment. And then you know what your number is. Once you've got your number, you put that number into, there are quite a few very good online sites that, you can specify a price for a car. And then you start to look for what you can afford, as opposed to the other way around. Because I've fallen into that trap too many times to count. I'm certainly not bragging here. I'm a victim of myself, which is, I love the new car, whatever it is, and let's find a way to make that work. And then I look at affordability last, and it's just such a mistake. So for Thabiso and everybody else that's listening, that's not the way to do it. The way to do it is the Bruce way. Start with the lump sum. This is what I can afford. And then you start to work on all the other criteria. And I think there's a lot to go in, but that's the starting point, Bruce.
There's nothing that focuses the mind more than saving money and then deciding how much of that money you want to spend on an asset that depreciates the moment you drive it off the showroom floor. And it will change your expectations of what you want to drive. You may think that you look best in the latest Porsche or the latest Mercedes or the latest Audi, whatever it might be. You may think that's where you look best. But you maybe have champagne goggles on. You've got beer money and champagne tastes. And the temptation is to take your 300,000 Rand and to put it down as a deposit and get the car that you look good in, because it's only 7,000 Rand a month, as you say. So a couple of rules here, Warren. One, set a budget and stick to it. Whether you're financing the car or paying cash for it, stick to the budget no matter what. If you are financing it, get the biggest possible deposit that you can to throw against the price. Get the shortest term you can and ensure that by the end of that term, that car is paid off in full. And then you probably get another 5 or 6 years drive out of it.
I think there are a few things to add there. One, even though the dealerships or the finance houses might offer you a term longer than 5 years, you definitely should not do that. As you said, the car is losing value every single second of every single day that you own it, even if you're not driving it. So you simply cannot finance a car over 7 years and convince yourself you've made a good financial decision. The truth is you have not. And so if you take a finance period of 5 years, that's fine. Make sure you do everything you possibly can to pay it off over 3, and do whatever you can to make that work. And then we work well with others when it comes to decisions like this. So one of the things you really should do is to talk to someone in my life that's my wife, who's totally unemotive about cars. And we make the decision together. If you're single, then maybe you need to phone my wife; she'll help you. But if you're single, what you need to do is find someone who doesn't like cars, who's not going to get excited about them, and help them help you make this decision. You make the decision together, because it's all good and well finding your best friend who's equally addicted to cars to kind of gee you up to say this is the best decision you could ever make. You're going to look great in this car, but actually kind of finding a car buying buddy who is not emotive about cars is a really sensible way to manage your own emotions, and it's a way of holding yourself to account for something that you might not be strong enough to resist. And I'm speaking from experience. So do this, do yourself a huge favor here, is allow someone else to help you make a decision if you know that you're not going to resist. If you're one of those people that just don't care about cars, well then you don't need anybody to help. It's a straight financial decision. But understand the car is going to lose value. There is no way that anybody can convince me that cars are an investment. The rare situation where a car goes up in value is extremely rare, and it's just one of those things that you shouldn't be doing. When we're buying mass-produced cars, they don't go up in value. That's not what we're talking about here. And then you're right, don't do the balloon payment. That's that's just a way to kind of do your weapon of wealth distraction. So a big issue for me is big deposits, pay it off over 3 years. Get your, someone you trust and understand to help you with this, and someone you respect that you'll listen to their decision. And affordability is lump sums. And then the big thing, and the car companies will hate this, is, why on earth are you buying a new car? The fact that cars get sold with service plans and motor plans and all those things, that's a story we tell ourselves. That's a thing of it's so expensive to service a car. I'm just going to buy it buy it new, and then I've got 5 years to drive it. You go and buy, a 3 or 4 year old car that's well maintained, well serviced, and you can get cars checked now. You don't need a dealership to service that car for you. There are many very good motor mechanic operations out there that will service the car equally well, and I'm not saying don't service the car, you definitely should, but you don't need to pay the dealerships to do it. They're way more expensive than the person around the corner who's using the same parts and doing it at half the price. I'm saying half the price as an example.
No, absolutely. But also the process of understanding what you are in for when buying the car, because so often we look at the price tag. And yes, now we're going to buy this 4-year-old car, as you suggest. It's out of motor plan, so now we are liable for the services. Does this brand have affordable parts, or are the parts notoriously expensive? Does it take a long time for the parts to arrive in the country? Be aware of that, because if the parts can't take a long time and something breaks in the car and you don't have a car for 2 or 3 weeks, you're going to be renting a car or taking Ubers or whatever the case is. There's an additional cost. Have you checked the tires to see if they've got at least, 10,000 more Ks on them? Have you checked, where the repairs were done previously, whether they were done properly, and whether or not the service schedule was stuck to? And then, of course, it's not just the insurance that you've got to be aware of, because also insurance doesn't go down, despite the fact that the value of the car decreases every year. The price of insurance goes up because the insurance companies say, well, no, our parts go up every year, and if we have to replace parts in your car during an accident, well, then that becomes more expensive. And then, of course, there's this nasty little thing of interest rates, because if you're financing your car, that's all well and good, but my goodness me, how are you going to cope with 10 interest rate increases in 2 years? Can you survive those should they occur? And that's precisely where a lot of people are coming unstuck at the moment.
And I think there are two aspects to this. One is circling all the way back to Tabiso's question around letting your interest rate float or fixing your interest rate is something we need to talk about. And then I think both the insurance companies and the finance houses seem to me to punish younger drivers. So younger drivers tend to pay significantly higher interest rates and certainly pay very high insurance premiums, and there could be an argument on the insurance company's part that younger drivers are higher risk, but certainly that's a huge factor, and so to me, I haven't seen a good finance deal where you fix interest rates that actually work in the favor of the client. To me, what you find is if they fix an interest rate, I mean, let's say now prime's at 11.25. If you get offered a fixed rate the likelihood is it's not at prime. It's going to be at prime plus 2 or 3 or whatever the percentage is. And usually those fixed interest rate deals get offered not long before interest rates start coming down again. And so I've never found a deal where I would be kind of tempted to fix the rate. I think making sure that your interest rate is linked to prime is good, and understanding that when prime is at 11.25 and a dealership comes to you and says, we can finance your car at prime plus 2 or prime plus 3, you're in a situation where you're nearly paying 15% on interest a year. Understanding that when you're paying 15% interest, it's doubling against you every 5 years. So if you buy the car today at 100,000 Rand, you've paid at least another 100,000 Rand in finance charges over the next 5 years. And remember, the car that you bought for 100,000 Rand, by the time you sell it, is probably worth 50,000 Rand. So you've ended up costing yourself 100,000 of finance charges plus losing 50,000 just in the value of the car. So you need to try and get the lowest interest rate you can. And sure, you can't always negotiate with the banks. Paying a big deposit helps. But what you can do to protect yourself then is pay off that car as fast as you possibly can. So even if you are getting drilled at prime plus 1, you stop the pain as fast as possible. And the one thing you can control is pay off that car much, much more quickly than the 5 years. And as I said earlier, please don't do it over 7, because then you're in it probably 150%.
The trouble is when you're buying a car over 7 years and you can't afford the car, they were told you it's affordable, but you actually couldn't afford it. And you get to the end of the 7-year period and you say, thank goodness that is over. I've now got a 7-year-old car. Except you've driven it quite hard because you're a rep or whatever the case is, and it's almost time to get a new car. Oh, and there's still the balloon payment, because that balloon payment is Satan's little surprise for you once you think you're done with the payments, and that's quite frightening.
It is, and just to understand balloon payments for a second. So let's say they tell you at the end of the period you're going to need to pay in another 100,000 Rand. That 100,000 Rand is not a loan that they've given to you interest free. They are charging you interest on that 100,000 for the entire period of the finance deal. So if you've taken a 7-year deal from the finance house and you're paying off at the end another 100,000 right at the end. All of that you've paid interest on for the entire period. So you've paid the 200,000 Rand, car price, plus now the balloon right at the end. You're paying interest on that right at the end. So the balloon payment is an extremely lucrative thing for the finance house and for the car dealership. For you as the buyer to now make a car affordable, just understand. A 7-year car finance deal with balloon, you've probably paid 1.5 times the price of the car just in finance charges. It's not affordable. If you can't buy the car with the deposit and get it done over 5 years, the truth is that car is not affordable for you. You need to change your price bracket and look at something that you can afford. That's the hard truth.
And just be aware of the fact that interest rates do go up, and they can go up for quite a long time, and they can stay higher than the rate at which you bought the car for longer than you think. And if that occurs to you, you could get caught short, and you'll find yourself in financial trouble, because there's also maintenance and running costs on these blooming things. And that is a reality for it. So Thabiso wants to replace his 10-year-old car with a decent low mileage demo model. No problem there. Saved funds for the purchase, but he will need to take out vehicle finance for 40% of the vehicle, and he wants to pay it off in 2, maximum 3 years. I'm guessing 2 is better than 3. Not sure if you go for a fixed rate or linked interest rate. The linked interest rate, the floating interest rate here, Warren, I would argue, and I would concur with you, where we are in the interest rate cycle at the moment. There may be one interest rate hike coming. Is it likely we're going to get another 4 or 5 interest rate hikes? It's possible, but not likely. And, on that basis, you'll be paying a much higher premium than you need to on this car for the duration of your contract, because if you believe the rates are coming down fairly soon, you'd be mad to fix your rate.
It's absolutely true. I think, if we do get one more rate hike, and let's say Thabiso has to finance the car over 3 years, for example, there is a good chance over a 3-year period that rates do come down somewhere along the line, maybe later on. So I would certainly not fix the rate. And And then, it seems like Tabiso knows what to do with this. So certainly paying off the car quickly again makes all the sense. And I think with fixed rates, you might even be penalized if you paid off the car earlier. So again, just another argument against a fixed rate. So no, please don't fix the rate. Go with floating. And everything else that Tabiso wants to do, I think, is amazing. A big deposit, pay off the car quickly, and if you get, if Tabiso gets it done over 2 years, great. That's exactly the right way to go with this.
Warren Ingram, personal financial advisor and director at Galileo Capital, with good insights and good wisdom this evening when it comes to the process of buying a car. You are going to need to buy a car. You're going to need to buy several cars. If you can't afford to save the money to buy it for cash and limit yourself to a maximum price tag, and you do need to finance it, please listen again to the podcast. It's absolutely critical that you go in forearmed, because the temptations, air conditioning, leather seats, the temptations.